Japan has more millionaires per capita than most developed countries. Their average salary is lower than the US, lower than Germany, lower than Australia, and yet more millionaires per capita than almost all of them. That gap has nothing to do with luck, inheritance, or some secret investment club. It has everything to do with one thing most American investors are still doing completely wrong. And once you see what it is, you cannot unsee it. Here is what the finance industry has been selling you. Find the right stock before it takes off. Time your entry. Get in low, get out high. And if you are not doing that, at least pick a fund manager smart enough to do it for you. That is the game most people are playing. Stock screeners, earnings calls, Reddit threads at midnight, trying to figure out if a semiconductor company is undervalued. Marcus, 31, tried this twice. First time he picked 3 stocks he genuinely believed in. 2 of them dropped. He sold. They recovered 6 months later without him. Second time, he waited for the dip, bought in, watched it dip further, panicked, sold. It recovered again without him. Marcus is not stupid. Marcus was playing the wrong game. Here's the thing nobody in the finance content space wants to say out loud. Picking stocks generates trading fees. Timing the market sells newsletters and courses. Complicated portfolio strategies justify advisor fees. Boring automatic dividend-focused investing generates nothing for anyone except the person doing it. Funny how that one never trends. Funny how you never see a sponsored video about just buying SCHD every month and forgetting about it. The Japanese figured out a long time ago that the goal is not to be the smartest person in the room. The goal is to make the fewest mistakes over the longest period of time. Consistency over brilliance. Time over timing. Boring over exciting. These are not motivational poster phrases. They are a description of what the math actually rewards. And the math does not care how exciting your portfolio story is. It only cares how long you stayed in the game and how often you showed up. That is the entire premise of what we are about to walk through. Before we get into the rules, let's talk about why most people quit. And I do not mean quit investing entirely. I mean quit the specific approach they started, somewhere around month 4 or month 7, usually right after the first time the market does something scary. The reason is not laziness. The reason is that most investing strategies require you to keep making decisions. Every week, every month, every time something moves, you have to decide whether to buy more, hold, sell, rebalance, switch funds, do something. And every single one of those decision points is an opportunity for your brain to panic. Fear and greed do not show up once. They show up every time you open the app. The Japanese approach removes the decision, not the risk, the decision. You set the amount, you set the date, it happens automatically, and your brain is no longer invited to the meeting. The system runs on 3 rules. Rule 1, invest the same dollar amount every single month regardless of what the market is doing. Not more when you are feeling confident, not less when you are scared. The same number every month automatically. This is called dollar cost averaging. Think of it like a gym membership you actually use. You do not renegotiate the price every month based on whether you feel like going. You pay, you go, it compounds. Rule 2, focus on companies that pay dividends and increase those dividends every year. Not growth stocks chasing the next breakout quarter. Utilities, consumer staples, real estate investment trusts. Businesses that have been paying shareholders reliably through recessions, through pandemics, through every kind of market chaos you can imagine. I know, not sexy. Your portfolio will never go viral on Reddit. That is exactly the point. Rule 3, reinvest every dividend automatically. Every payment buys more shares, which generate more dividends, which buy more shares. You are not spending the income. You are using it to grow the machine that generates more income. The Japanese call this the power of compounding. Every culture with a word for math calls it the same thing. The whole system on paper looks almost offensively simple. A fixed amount, boring companies, automatic reinvestment. Nothing to talk about at dinner parties. No story to tell. And that is precisely why most people do not stick with it, because our brains are wired to equate activity with progress. Checking the app feels like doing something. Researching the next ticker feels like being responsible. Doing nothing while the automatic transfer runs in the background feels irresponsible, even when it is the single most effective move available to a regular person with a regular income. $150 a month into boring dividend stocks. Nothing to post about. Here is what that looks like in 15 years. Let me show you the number that makes most people immediately dismiss this entire strategy. Rachel is 28, works as a nurse in Charlotte, North Carolina. After rent, student loans, car payment, and groceries, she has $200 a month she can put toward investing. Not $200 after maxing out her retirement accounts and fully funding an emergency fund. Just $200, period. That is what she is working with. After 5 years of doing this exactly right every month, no breaks, her annual dividend income is approximately $480. $40 a month. I know how that sounds. Stay with me. Years 1 through 5, Rachel puts in $12,000 total. Portfolio value around $15,200 because the market has been doing its thing. Annual dividend income $480. She is not quitting her job. She is barely noticing the dividend deposits. Years 6 through 10, total invested $24,000. Portfolio value climbs to around $39,000. Annual dividend income is now $1,760. Still not life-changing, but something has shifted. The dividends are now buying a meaningful number of new shares every quarter, and those shares are generating their own dividends. The snowball is not big yet, but it is rolling. Years 11 through 15, total invested $36,000. Portfolio value around $83,000. Annual dividend income $4,200. This is the tipping point. This is the year Rachel's money starts earning more than she is putting in. She is contributing $2,400 IGA. Her dividends are generating $4,200. For the first time in her investing life, the portfolio is outworking her. Years 16 through 20, total invested $48,000. Portfolio value approximately $156,000. Annual dividend income $9,300. She has put in $48,000 of her own money. The rest of that $156,000 was built by time and reinvestment. Now the portfolio allocation. This is not complicated. 60% in broad US dividend ETFs, specifically funds like SCHD or VYM, which give you instant exposure to hundreds of dividend-paying companies without having to pick individual stocks. 25% in international dividend companies, because limiting yourself to one economy over 20 years is a bet you do not need to make. 15% in real estate investment trusts, which are legally required to pay out the majority of their income as dividends and typically yield higher than standard equities. That is the whole portfolio. 3 positions: automatic contributions, automatic reinvestment. Rachel checks it once a year, adjusts if the allocation has drifted, and otherwise leaves it alone. The spreadsheet looks great. The numbers are clean and the trajectory is clear, and everything makes logical sense on paper. There is just one problem. The spreadsheet does not have a column for March of 2020, and that is where most people's version of this story ends before it ever gets to year 15. Between February 19th and March 23rd of 2020, the US stock market dropped 34%. 23 trading days. That is not a correction. That is your portfolio getting cut nearly in half, while the news is telling you the global economy might be structurally broken. If you had been doing this for 7 years, at that point you had roughly $18,000 in your account. By the end of that month, the screen was showing $11,900. $6,000 gone. On paper, in less than 5 weeks, and the automatic transfer was about to pull another $200 out of your checking account to buy more of the thing that just lost a third of its value. Your brain, doing exactly what brains are designed to do, is screaming at you to stop. Cancel the transfer. Move to cash. Wait until things stabilize. That is not a character flaw. That is a completely rational response to information that looks catastrophic. Here is what the math says. The person who canceled the transfer in March 2020 and moved to cash locked in the loss and missed the fastest market recovery in recorded history. The S&P 500 recovered its losses within 5 months. The person who kept the automatic transfer running bought shares at the lowest prices they would see for years. Every $200 that month bought more shares than any month before it or after it for a long time. The brain called it a disaster. The spreadsheet called it the best buying opportunity of the decade. This is the part nobody who sells investing courses wants to talk about in detail, because the honest answer to the question of how you get through a moment like that is not a strategy. It is just knowing in advance that the moment is coming. The crisis does not arrive as a crisis. It arrives disguised as obvious evidence that you should stop. Every instinct you have is going to tell you the situation is different this time, that this particular drop is not a temporary dip, but a permanent new reality. It has never been a permanent new reality. Not in 2020, not in 2008, not in 2000. The market has recovered from every single one. The only people who did not recover with it are the ones who got out and waited for a signal that it was safe to return. That signal never comes. You just watch it go back up without you. Knowing this in advance does not make March 2020 feel okay, but it makes it survivable. And surviving it is the entire game. Before the steps, one honest number. If after your actual bills you have $100 a month to invest, not $200, not $3, $75, $100, your year 20 portfolio value is approximately $78,000 and your annual dividend income is around $4,600. That is not the version of this story that goes viral. But it is a real outcome for a real person starting with a real constraint, and it is 100% better than the alternative, which is waiting until you have the theoretically correct amount and never starting. Step 1. Open a brokerage account that allows automatic monthly investments and fractional shares. Fidelity and Schwab both do this for free. Set the contribution to whatever number you just figured out. Not what you think you should be able to invest. What you can actually invest right now every month without thinking about it. Step 2. Buy SCHD or VYM or both. That is it for the first year. You do not need a sophisticated multi-asset portfolio on day one. You need to build the habit of not touching it. Step 3. Turn on dividend reinvestment. Every brokerage account has this as a setting. It takes 30 seconds to enable. This is where the compounding actually starts. Step 4. Set a calendar reminder for 1 year from today. That is the only time you are allowed to look at the allocation and decide if anything needs adjusting. Not monthly. Not when the market drops. Once a year. Step 5. Delete the brokerage app from your home screen. Not from your phone. Just from the screen you look at 50 times a day. Here are the things you will want to do that you should not do. Check the balance when the market is down. Move to cash when things feel uncertain. Sell a position because a YouTuber said something scary. Add a new exciting ETF because it showed up in your feed. I have done at least 2 of these. The boring version wins. It has always been the boring version. Rachel, at year 20, has $156,000 in a portfolio she built on $200 a month. Her annual dividend income is $9,300. She did not get a raise that changed everything. She did not pick the right stock at the right time. She did not have a rich relative, or a lucky break, or a year where everything clicked into place. She just did not stop. That is the whole story. Not inspiring in a way that makes you want to share it at a dinner party, but real in a way that actually changes what your life looks like at 48. 20 years from now is going to arrive regardless of what you decide today. The question is not whether you have enough discipline or enough knowledge or enough money to start. The question is what you want the account to say when you check it for the first time in a long time and realize how much time has passed. The people who built real wealth with ordinary incomes did not do something extraordinary. They just refused to quit during the months when quitting felt completely reasonable. $200 a month. Boring companies. Automatic reinvestment. Ignore the noise. Check it once a year. That is the entire system. 400 years of rice merchants and compound interest and human psychology all pointing at the same answer. The best investment strategy is not the most sophisticated one. It is the one you can execute on a Tuesday morning without thinking about it and then leave alone for the next 2 decades. Start the transfer. Then leave it alone.